Hey everyone, this is Michael Blanc. Today I want to talk about something very exciting that's relatively new, but it's called crowdfunding as a way to finance your real estate deals. So this is a relatively new thing. I don't want to get into the legalities of it because I'm kind of a business person, right? But what's exciting to me is a few weeks ago I went to the REI Expo in Washington, D.C., and there were some people that talked about crowdfunding. And I kind of knew what crowdfunding was, but never really thought of it as a serious source of capital. But that is starting to change. So late last year, 2013, SEC laws changed to the point where entities could raise money in smaller increments from a wide variety of investors. Normally, SEC laws prohibit an investor or a sponsor basically from raising money, from soliciting others to raise money. So I can't just put up a banner or send out a bunch of spam emails to try to get investors unless certain various circumstances. Now this law has changed that, and it's a new thing and it's evolving rapidly. But the idea is the following. You have a web portal where, let's say I'm an investor who wants to invest my money and get a reasonable return. I will register with a portal, and as deals come in, I might be able to invest $500, $10,000, or whatever amount I want. And if I am the operator or the sponsor, the person who actually has to do the deal, I think they're called an operator. Let's call them an operator. So I would be the operator. And the operator is the one who has the deal, who puts the deal together, raises the money, and operates the deal, etc. So anyway, I want to talk about that because it is kind of interesting. And what's happening is this has been going on for a good 6 months or so, where money can be raised for house flips. That's the model that has been understood, and that's starting to change now for buy and hold, which is of course relevant for an apartment investor like me, and I'm looking at that as a potential unlimited source of funds. So I want to talk about that. I didn't do a complete thorough analysis of all the crowdfunding portals out there. I just know about two, and the reason I'm talking about these two is because I want to talk about the two different kinds of models. So the first model is debt funding. Debt funding means, let's say, well, we'll do an apartment building investing. So if I want to buy an apartment building and I'm paying $1 million for it, and I need $200,000 down, the idea would be that I can raise debt through a crowdfunding portal. And one of those is Patch of Land. So patchofland.com would be one of those things. And what they want is they simply charge you a simple interest rate. And they're normally between 10 and 13%, normally around 12%, right? So you're getting a $200,000 at 12%, and you would use that money in second position behind the bank loan. Or it could be used to renovate the property, which is probably the more logical way to use it. So it's a 6 to 12 month loan, and then once you stabilize the asset, you then refinance out and put traditional financing in place. Okay, so let's say you're buying a quad and you need $300,000 of cash, which includes the construction funds. You would get this almost like a hard money loan, basically. And the terms appear to be more favorable. They're not charging 5 points. They're charging, I think, 1 point or something like that. So it's already cheaper than hard money. And the term can be a little longer. So that's the debt financing. It's not normally used for buy and hold, but it could be if the cash flow supports it. Now the second one, which is more interesting to me as an apartment building syndicator, is on the equity side. And one company I've talked to now is ifunding.co, and they raise money on the equity side. Now the way they do it there is this is for buy and hold situations. So this is actually, you got a conventional bank loan for whatever, 80%, 70%, and then you have equity. So if you're raising money for investors, you could have 2 investors in there and then iFunding as a third investor, because they will always invest as their own entity, even though the investing pool that they bring might consist of 100 people, right? Who knows? It's not really it doesn't really matter. And they can close very quickly, 14 days or so. But the way they do is they want a preferred rate of return, usually around 8%. That means, let's say you get $100,000 investment from iFunding or from any investor. 8% means that of all the cash flow, you pay out the first 8% of that, which is $8,000. So let's say you have $10,000 of cash flow for this. The first $8,000 is paid out to the investors first. So that leaves you with $2,000 of cash flow to distribute. And normally what they want is, so they want 8% preferred rate of return and then some kind of equity, TBD. Okay, normally if it's 8% preferred, it's pretty high preferred rate of return. They will get a little bit of equity, a little bit of upside, maybe like 25%. That's all negotiable, of course, but it's not like 80%. It's not like you're giving them 8% preferred rate of return, which is the vast majority of a cash flow, and then you're giving them the majority of the upside, which leaves you with nothing. So don't do that. That doesn't make any sense at all. So 8% preferred return plus say 25% equity. So of the 2,000 in this my example, you're paying out another 500 to the to iFunding or your investors, and then you keep the $1,500 of that cash flow. Now, the cool thing about this is, of course, is let's say you're doing a value play, and let's say within 3 years you've increased the value of the property by whatever, 25, 50% because of the improvements you made and the rents you increased. You can now refinance out iFunding. And now all of a sudden the preferred rate of return goes away. They still own 25% of the building, but now it leaves you with 75% in the building. Yes, so your cash flow goes down because your debt service is higher, but you hold on to another 5 years and you can really build massive wealth. So to me, the terms of the crowdfunding appears to be very favorable. They're not like a venture capitalist who wants an 8% pref and 90% equity because they're putting all the money in. It's not like that. It seems to be much more reasonable. So look into it. It might be a really attractive option to finance your apartment building deals. All right, talk to you all later.